All right. Hello, everyone. I want to talk to you a little bit about the RSI indicator, the relative strength index. This is a way of measuring momentum. What is momentum? It's not volatility. It's a different thing. Momentum is how far a security, I'm going to just say stock as my default, but how far a stock has moved from time period A to time period B, within a certain whatever that time period is in there. Now, the vast majority of times, a stock trades within what would be its typical or usual or historical trading range. If we get above that, we call that overbought. And if we get below that, we call it oversold. Now, why is this important? Well, when things are overbought, it attracts sellers into the market because they're going to be expecting a reversion to the mean, and their sell orders in and of themselves could push the stock back into the average range. The opposite is true when something is oversold. That's going to attract buyers into the market. They're going to be expect a reversion to the mean or a move higher, and their buying could push the stock back up into the range. So I'm just going to start here with the S&P, and I'm going to go click on this indicators thing here. And this is going to show you these different things. And this is a trading view, which I use. It's pretty good, pretty relatively well priced. And I'm going to look at technicals. Now, see all these technicals here? There's, gosh, I don't know, 100 of them. The vast majority of these are probably different ways of measuring momentum. Now, you have to remember these are all different ways of measuring the same thing. Is one of them better than others? Yeah, I don't know. I think there are some that are a waste of time, but is a legitimate one, like say the relative strength index, or some people use stochastics, or some people use moving average convergence divergence. Some people use rate of change. I don't know if one is better than the other. I don't think they are. Everyone has a different eye, and what some people might see, and one thing another person might not see on another, or this or that, or the other thing. So I'm going to just bring up the RSI. The rules that I'm going to speak about over the next however long apply to pretty much all of these indicators, at least the ones that are good. Or we call them indicators or oscillators. So here is our RSI, and I have the S&P 500 up here. And if the blue line gets above this horizontal red line, it indicates oversold conditions. And that draws sellers into the market, and they can push the price back down. Notice how right here we got this at the exact top. This was a good time to sell. Here we have oversold, and this was a good time to buy. Right now we're extremely overbought. So a couple things here, and let me just bring up I think I'm going to bring up Union Pacific just for the heck of it. Union Pacific Railroad Corporation. Now, what I want you to understand is a couple things here. One is that there are tools and there are rules. Okay, tools and rules. A tool is something like an indicator, like an oscillator, something like the RSI. Okay, you got the tool. How are you going to use it? What are your rules going to be? Someone can give you a guitar and it's a good tool. Well, it's more of an instrument, but you get my point. It's a tool. What are you going to do? Are you going to play the blues? Are you going to play jazz? Are you going to play classical? Are you going to play flamenco? There's really no right way. Everyone has to have their own rule. You have to come up with a set of rules. As a matter of fact, what is a trading model? It's a set of rules. Let me give you an example. In trading models, we have what we call a setup, which is the get ready. And then we have the trigger, which is the hey, go buy or sell or whatever it is you want to do. So here we have the RSI gets to overbought territory. We're looking at Union Pacific, and that's the setup. What could the rule be? And I'm not giving a recommendation. I just want you to think in terms of, I need rules. I need a specific set of parameters for me to take a position. If not, you're just guessing. So your setup is okay. We got overbought. What's your trigger? What is the thing that's going to make you sell or take a short position, meaning buying a put. So the tool is okay, we got the RSI. The setup is we got overbought. The rule is, well, another rules, because those are both rules. When we get back within the red line or back within the range, when the RSI gets back below this red horizontal line, that's the trigger. This is where you sell. That is the rule. The tool is the RSI. The rule is when we get above the RSI, we pay attention. When the RSI gets above this upper threshold, we pay attention. When it gets back below it, that's when we make our trade. That is the rule. The tool is the RSI. The rule is, hey, this is what we're going to do. Now, I'm not suggesting that this is the perfect thing to do. Again, this is just an educational thing right here. And I just want you to learn that most trading models have what we call a setup, which is, hey, the get ready, get set, that's overbought, oversold. All right. The trigger is when you actually get into the trade is when we stage a reversal or something happens that makes us get into the position. In this case, it's when the RSI gets back within this range. And then you have your exit strategy. All right. So this is RSI here. Now, one of the things I want you to understand is that everything in charting is fractal. The RSI has a default, and the default is it's measuring 14 time periods. Where we are now versus where we were 14 time periods ago. In this case, it's days. So, from this perspective, if we're significantly below or significantly above where we were 14 days ago, we're going to be oversold or overbought. Now, check this out. I'm going to go, notice this is a year chart. Actually, it's more, it's about 18 months. I'm going to go to year to date just to make it easier. Okay, so there's our year to date. And I'm going to go to the 1 day chart. Now, here we have the same phenomena. If we get above this upper threshold, it tells us we're overbought. And if we get below, it tells us we're oversold. But in this situation, we are measuring 14 minutes. This is something a day trader would use. This is this is the fractal nature of charting. The same principles or the same things play out on different time frames. Why? Because when we look at a chart, we are looking at a graphical illustration of investor psychology. If something gets overbought, what does that mean? It's investor psychology. Investors got so jacked up that they want to buy, they want to buy, they want to buy. They end up going in there at the end of the trend and they buy and they buy and they buy. It's the fear of missing out trade. Same thing happens on the downside. Markets going lower, investors start to get afraid it's going to go even lower, so forth and so on. So we get oversold. Being oversold is a psychological thing. They're afraid they're going to miss out. Now, so that's kind of a fractal nature. Let me just go to the 5 year, see if we see anything there. Now we're looking at weeks. So if you didn't have a time frame down here, you wouldn't know what this is. It could be a 1 day chart, it could be a 2 month chart, it could be a 1 year chart. The reason why we see these same things play out or these same patterns form on charts of different time frames is because the chart is an illustration of investor psychology. Investors who trade for different time frames have the same psychology. Investors who are day traders, they get freaked out if something is going too low and they panic and they sell it out. They sell the baby with the bathwater, so to speak, and it gets oversold. Opposite is true on the way up. Investors who have a longer time frame, like we're looking at here, we're looking at a 5 year chart, they can get oversold or they can get overbought. So if you understand that a chart is a graphical illustration of investor psychology or human psychology, then it makes it much easier to understand. Now, I guess I'm just going to come back to Union Pacific here. Actually, let me go to Tesla. Everyone loves Tesla. The same rules apply on any security. Okay, so here's Tesla from our looking at 14 time periods. So we're looking at days. Look at here. Tesla here was the most overbought that had ever been in history. This is the very end of 2021, right at the very end of the 10-year bull market. All right. Fear of missing out. Look at this buying. It went parabolic. People are just, you have these people that are like, oh, okay, I'm going to watch it. I'm going to wait for the price to get better. I'm going to watch it. Finally, they get sick of watching it go higher and they finally say, okay, I'm going to go in there and I'm going to buy. These are the last people to the party. So they're panic buying because they're afraid they want to miss out. We get really overbought. What does this tell us? People are afraid. They're afraid of missing out. Sure enough, this was a perfect time to sell. Now, if we come to here, the end of 2022, we have the opposite. We have, based on this indicator, the most oversold Tesla had ever been. Sure enough, it's a good time to buy. Now we're overbought again. Is it a good time to sell? Yeah, probably. Probably going to see some profit taking. Now, here's what I want you to understand, and I think this is probably the most important thing that I want you to learn in this lesson. Is a lot of newer investors don't understand this, but we can play with the settings, okay? And there's nothing wrong with that doing that. Let me go back to Union Pacific. If you go here, and this is trading view again, you can look at this. All right. I said before, this default setting of this is 14 time periods. Maybe that's good. A lot of times the default setting is works, but you can change this. If there's something you're looking at that it doesn't seem to 14 doesn't seem to be the good time frame, well, maybe you go to 10 time periods. Notice how it changes. Maybe it's not 10. Maybe it's, I don't know, 25. I'm just guessing here. Okay, 25. Who knows, right? You got to kind of, this is what we call optimization. Use different, the settings for one stock might be great, but those same settings might not work for another stock. So we can change the time frame. If you're trading the same things, if you have a limited list, like say you're just trading biotech or whatever, you should go through all your stocks and just see like what works on each thing. Now, if I look over here, this is Union Pacific again. it, the default setting for this indicator is 70. If we get above this red line, we're overbought. Why is the default setting 70? I don't know. It's probably because the person who invented this indicator or who developed it just said, all right, well 14 is a good time period. And if we get above 70, that's a good overbought signal. But look at this Union Pacific. Okay. This is a railroad stock. I guess in theory, you could say it's boring. We get all these situations here where we get overbought, but it doesn't show up down here on the oscillator. Well, you know what? Maybe, well, I shouldn't say maybe. I'm just kind of being theatrical, but maybe this is a stock that is overbought when the reading is less than 70. So let's go in here and change our settings. And we're going to drop this from 70, which is the default, down to, let's say, 60. Okay. Union Pacific gets to, actually, let me may even take that a little bit lower. We're going to go to, I don't know, just 57. When we get to 57, we're overbought. 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 This particular stock, Union Pacific, is overbought when the RSI gets to 57. Okay. It doesn't need to get to 70. It is overbought when it gets to 57. There are some stocks that are really volatile, like, some biotech stocks that get overbought when they're above 70. Maybe they're at 75 or 80. So, what I want to just tell you is, or what I want you to take away from this is that sometimes the default settings are not optimal. And you can go in here and you can change the default settings. So, 70 doesn't give you really any signals. But if we drop this down to 57, well, we get a lot of great signals. Look at the bottom for the oversold readings. Well, the default is 30. And you might get here and say, oh, gee, we're not oversold, but we really are. Oh, we're not oversold, but we really are. All right, well, maybe we need to give us less room. This is a railroad. I don't want to say it's boring, but it's not you know, uh, a crypto stock or an AI stock. So let's tighten this up. Let's go up to say, let's go up to say 30. I'm going to go over here to my settings. I'm going to go up to say, actually, I'm sorry, I said it wrong. Let's go up to, I don't know, just the hell of it. Let's say 40. Now, all of a sudden, the picture changes. Oh, we're oversold. We bounce. 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 So the takeaway of this is that these indicators that measure momentum come with default settings. And sometimes, and a lot of times, the default settings work pretty well. But every stock has a different personality. And the default setting here is, oh, something's overbought if the RSI gets over 70. Well, for some stocks, 70 might not be overbought. It might have to get to 75 to be overbought. For other stocks, like we saw here, it doesn't have to get to 70 to be overbought. Excuse me. If it gets to 57, we're overbought. So that's kind of the lesson for tonight. I just want you to remember that momentum oscillators or indicators come with default settings. A lot of times those default settings are good, but a lot of times for a particular stock, they can be optimized. And what is the default setting is not going to be as good as something that you could kind of tweak out and make better. Like for example, if I was trading UNP, I would not wait for it to get to 57 or sorry 70 to be overbought. I would start looking at this for being overbought when it's at 57. And on the downside, same thing is true. I'm not going to wait for it to get to 30 to be oversold. It's going to become oversold at a higher number than that. So these same rules play out on pretty much every momentum oscillator. So that's it for tonight, everyone. If you have any questions, please let me know, and I will talk to you soon.